Welcome, team. Happy Tuesday. We are back here on our SPX Daily Analysis with Doc. Welcome, Doc.
Thank you. Welcome, everybody.
So yesterday was, of course, probably one of the craziest day of the year. We saw obviously a massive market drop, and obviously we had a lot of like comments in the chat on risk management. How do you prepare for a day like yesterday? The answer is, of course, nobody can predict a day like yesterday, but what we can show you today is some tools on how you can leverage, and also we're going to go into risk management. So Doc is going to talk about how you use risk management techniques, and then of course we're going to go into the analysis. The first thing that we want to look for is, of course, yesterday we saw a big market drop. The market kind of rebounded, so we're now positive on the future side right here. And what we also want to look for is look at your dashboard, and as you can immediately see, we now see a slightly positive green. So yesterday, if we go back to yesterday, everything was red or almost red. So we had the neutral seasonality. And now if we're moving for today, the seasonality has turned positive. So I think we mentioned this in an email. The goal of this score, so this is our Q score, which is our quant models to give you a very quick snapshot of the situation of the market or the asset that you're looking for today. So we see obviously a change in seasonality. So we now, and we can open up our seasonality chart. You can immediately see the historical performance of this core. We basically were seeing a sharp decrease in seasonality that kind of like predicted this kind of down move, and now we've seen kind of our seasonality increasing right here. So now it's like at 1. So what we want to monitor, and we're not going to say that this is like the bottom, but like monitor the seasonality trend, and Doc has also something to add after, because that could be important. We see the same picture if we look at QQQ. So we're still kind of like in a negative gamma environment. We're in a very low option score, very low momentum, but we do see an increase in seasonality. And same picture, seasonality drop down here. We saw obviously this massive drop over the past few weeks, and now kind of seasonality bottom right there, and now it's kind of like going back to the positive territory. So with that said, Doc, let me know if you have anything to add here, and then I'll pass it back to you.
Okay, yeah. Hi, everybody. Good morning. So yesterday was one of those days, and we'll maybe talk about that a little bit more. About the seasonality thing, just a few quick observations. One, I think most of us who are traders who follow the option space, whatever, know that March tends to be the weakest month. February OPEX, we often top out in January, February. After February OPEX through March OPEX, COVID bottomed. Those of you that traded through that might have a little PTSD, but remember the COVID bottom, the official COVID bottom, the low was the day of the March OPEX. We've had other OPEXs where bottoms tend to happen in March, the March options expiration, give or take a few days. So, and there's structural reasons why. I'm not going to go into it. There's gurus out there that'll give you way more nuanced explanations than I can. But what I can tell you is it happens. It's true. It's a thing. Believe it. Um, so, and so interestingly enough, a number of flow gurus, flow mavens, Rubner being one of them, the more McElliott, I don't know if he said this specifically, target 314 Friday, which happens to be debt ceiling day or government shutdown day. Not because of that, although there's some volatility in the chain related to that, that might also contribute to that as a seasonal day to get long for a bounce. Not saying that the bottom is in for the year or whatever. We're traders here. We're not talking about like park your retirement money here today. We're talking about trades that might, so that this time period here might be a bottom. Might be a tradable bottom. We might have seen the low, uh, the local low for now. We'll see. Um, so that's an interesting thing to keep in mind. I'll talk a little bit about yesterday, just briefly. So we had a big sell-off, as we all know. And whatever the reason is, Trump, they asked him about a recession. He said whatever he said, or macro flows, or China, or whatever it is, tariffs, doesn't really matter. Whatever the trigger was, the market was nervous. And from my point of view, I don't have yesterday's options data in front of me. Once we broke some of those key levels, yeah, 5,700 was, one key level below the 200 MA, which was roughly 57.25. Once we broke below there was just, we're put dominated, so customers tend to be long puts, and as we go down, those deltas increase, volatility goes up, which makes those deltas increase more. Market makers have to hedge more and more to neutralize those negative deltas, and down we grow. We broke 60.50. Notice, whoops, I'm not going to spend too much time in the rearview mirror, but if you notice, we had kind of a little stall at 60.50, a little bounce, a little indecision there. And then once we broke it again, it was all the way down. Now I'm going to mention 55.65, where we bottomed, actually maybe 64 and a couple pennies. It's not a coincidence that we bottomed there versus 55.75 or 50. For those of you that don't follow it, JP Morgan has a collar hedge fund for high net worth people. I forget the barrier to entry. I think you have to have a million or half a million or 5 million to even for them to even be willing to take your money. Um, and basically, what this collar fund does, and if you're not familiar with it, I'll just go into it real briefly. They sell out of the money calls, roughly 3% out of the money, and they buy 5 to 15% out of the money puts, 5 to 20, long 5% out of the money, short 20% out of the money, wide debit spread as a collar, as a risk trade. So the most you can make is roughly 3%, and the most you can lose is 5% every 3 months rolling. The quarterly market, the quarterly is the largest one. So they put this one on in December when we were near the market high. So where we were in December. And so here we are at that level. 55.65 was their long put. So there's roughly 39,000 ish long puts at 55.65 sitting there. That's going to be magnetic. The closer we get in time and the closer we get to that number, that's going to be magnetic to the downside and bounce wise. And so Fabio mentioned managing yesterday. And so yesterday, because I tend to be a premium seller, iron condors, whatever, or sometimes just one side. I'll also scalp intraday. But so yeah, yesterday we went down. I was able to sell like way down here, 55.25, and I was using the levels marked out here and marked out in my daily plan to sell below. Now I did sell a few near 55.65 because I knew the JPM collar was there and there was large open interest at 55.50. I figured that would be okay. Once we broke 5600, I got a little nervous. Now, luckily, I closed out, not luckily, by design, I had closed out a lot of the puts that were closer to the money, 55.50-ish, for slight profit, slight loss. Obviously the calls, the short calls paid off. They were no problem. Also, I'll tend to buy little 5 or 10 wide debit spreads flies, the broker wing flies in the path of travel. Should we get should we travel against me for a little bit of the premium I collected? So let's just say I collect 60 cents times 10 premium. I'll allocate 25 cents times 4 premium, buying these little things in the path of travel. And usually we travel in both directions of the path, and I can monetize them for a couple bucks, and then I might add to it and make it a real trade. So anyway, but I still had a few left, and once we got to 55.65, I thought in theory that we should have a pretty strong bounce from there, and we did. And then we went to the 5,700, another big magnetic level, and up we went. Okay, that was yesterday. On to today. So we have the JP. The other narrative that we all know, I should hope, is Mag 7 momentum outflows. We've been hearing about this really for months. I think I started seeing articles during the August sell-off, money rotating into value, money rotating into Asia, China, emerging markets, Europe, etc. So there's more of that going on as well. Trump tariff nervousness, so all that's going on. So that's the jittery market environment that we find ourselves in today, because those things are still true. So now today we have jolts, some employment numbers, so that's going to be important at the possible inflection point. Um, we managed to be a little positive in the overnight session, up around 0.2%. Nothing to get excited about. And so we're still going to have to watch 5,600, the round number, on the way down. We're still going to have to look up on top. 55.30, 56.35 was the level I tagged. Where is it? It doesn't show up here. As a level I tagged, an intermediate level up to 56.50, which is the first major gamma level, and where I would expect to see a stall or a reaction. Should we get over there for whatever reason, 75, there's a lot of put open interest, there's call open interest. I detail it in my note a little bit. And then, should we get over that, there's a confluence of in the money puts and out of the money calls right here in the 56.95, 5,700 area. Likely stuff people put on maybe yesterday at the open when we were at 5,700, or last week. It doesn't really matter when they got there. There they are. And so these are going to be points to get over. And then there's also stuff at 20 and 25. So that's kind of like your max number. So now, yes, that's 100 points from now, but we traveled 100 points yesterday. So while I'm not expecting it, who knows? It's that kind of market. To the downside, and of course, one would expect continuation of the downtrend. 5,600 is the first level we're going to have to contend with. The expected move today is roughly 75-ish. So from 25, that puts us at 5,700-ish on top and 55.50-ish on the bottom. Nice round numbers to wrap your brain around. To the downside, 5,600, the round number, is your obvious first reaction zone. Should that fail, path down towards 55.65, the large JP Morgan level. Now the 55.95, 600 should be sticky. So he said, how do I manage my trades? Depending on where I am, I'll watch for reaction at a sticky level. And if I get a reaction in my favor, let's say I'm selling puts, I get a reaction in my favor. If I'm break even, a little green, a little red here, and it doesn't look like a strong enough reaction, or I'm watching flows, I'm watching VIX. VIX is acting funny, I might close them down and sell further down at a safer level. I might buy long put debit spreads right above it, turning it into a broken wing butterfly or a long condor. So I might do things like that to manage. Other standard risk management techniques are close out at 2 or 3 times the credit. Nothing wrong with that. I'm much more active in my trading. If I have a 20 wide debit credit spread, I might buy a cheap debit spread inside of it for 10 cents, minimizing my risk going down to that level. So I have lots of other management techniques that I use. Okay, let me finish with today's path. Now, 5550 is a significant number, round number, and below that 5565. Should we break it, I would look for a magnetic move back to it versus continuation down. Now, I noticed it during the day as I was poking around the chain because I'll look at flows, 0 DT, 1 DT. I'll look at a Friday. I'll look at CPI day, which is tomorrow. I'll just poke around and see where I see unusual volume or open interest. And I was noticing the 5,500 calls, puts rather, pretty early in the morning. I saw maybe 4 or 5 thousand of them coming in throughout the course of the day. I was just watching that level build up. Now, I don't know if that's institutions. That's because of the volume and the size. My guess was that it was institutions doing something related to other trades, maybe I can't give you the complex Greek of if they're managing their volatility surface, if there's some kind of calendars for events or whatever's going on. But there's a big open interest down there. I'm not sure why it's there. I don't think that anybody had that as a target, but who knows? But just pointing that out that should we break here, and if that stays there, suddenly that can become magnetic as well. 5,500. If I could sell puts down to 54, below 54.75 in the morning, I'm there. And actually, I sold a few just for fun yesterday. I think I got below 5,400 during the peak of the slaughter. If my memory serves me well, I got below 5,400. Okay, let's talk about the volatility space for a minute. And once again, I will disclaimer: I'm not a vixologist, but I know enough to get in trouble and to sometimes make money. Okay, so VIX yesterday popped to whatever it was 29.5, I'll call it, to the highest level year to date, and I took out the December VIX high as well. I saw a VIX peak in December 2nd ish, I think it was, and another peak around. Hold on, let me turn this into a line chart when we're looking at VIX. Let me change the time frame. 65 minutes. Why 65, not 60? Because 65 divides into a trading day evenly, and that way I don't break up the days. That's okay. So here we are on December 24th, FOMC. We overtook that one. A lot of us remember that December Apex sell off. And so, and you have to basically go back to the mini Volmageddon that we had in August. So that's a long-winded way of saying volatility is pretty extended. And we know volatility is mean reverting, but that doesn't mean it has to. Especially, we are heading into a VIX expiration, which is the Tuesday is the last trading day. Wednesday AM is the settlement. So some call it Tuesday, some call it Wednesday, potato. It's next week before the VIX before the OPEX. Now, I've noticed anecdotally that when we go into an options expiration, like we did in August, with VIX all bulled up, with in the money VIX calls, with indices down and put dominated, the clearing event of the VIX unclenching and then the SPX unclenching tends to give us the opposite picture than what we've seen up until then, which coincides with the seasonality observation that the MenthorQ new Magic 5-piece indicator makes, which is pretty good stuff. Uh, so we have some confluence there. Doesn't mean it has to. Absolutely not. Am I suggesting you back up the truck and load up? Absolutely not. But it's certainly an if then. This is all path dependent. So so VIX has come down a little bit. It's hard for me to see with all these. There we go. Come down a little bit from here. It's still elevated. We're gonna look in the VIX option chain in a second. The 1-day VIX, which is a measure of questionable usefulness, the way it's calculated. I tried figuring out a way to use it. A lot of other people have. It's meh, but it gives us an idea. And if you look in the option chain for the week, IV on the chain is saying roughly 30. So roughly 70-ish points a day, 65, 75. Now the VIX 9-day, which I like to look at in comparison to the VIX, that basically takes us out a week, which happens to take us to VIX expiration, is at 31. And so we're backwardated. The 9-day is higher than the VIX, which is 30-day. Remember, this is telling us April. This is not telling us what's expiring in a week. And the VIX 3-month is down at 25 as a normal curve. And when I go to the site, we'll pull that up. Maybe Fabio can preload the term structure while I'm doing this. VVIX, the volatility of VIX, once again, that's call it demand for VIX calls. Even at this elevated level, VIX was high. That's a demand for volatility, not necessarily VIX calls. If we want to get more nuanced, and again, just getting it into perspective here. So VVIX was a little higher during the December sell-off, the FOMC, I think it was, whatever, but not by much. And so just another thing telling us that we're kind of stretched. We're kind of stretched.
Let me know, Doc, if you want me to share the term structure.
Yeah, that's a good idea. Share the dashboard. Okay, so point out what you're seeing in the term structure there, or what I was talking about, since you have it up. Am I putting you on the spot, boss?
Yeah. Sorry, where do you want me to?
Okay, so if you look at the term structure there, you see how elevated it was. There you go. That's a month ago. It's kind of a normal-ish contango. And then look to where's yesterday's one?
The white one?
The white one. Look at how back it is. So look, you see a relatively normal one up on top, and you see the front end is way higher than the back end. That's not normal. And even a month ago, the term structure was a little funky, a little stretched, but now it's really, the front end is way elevated. And we want to see that look like a Nike swoosh, with it being higher in the back and lower in the front.
Yeah.
That's what we want to see. That would indicate And it makes sense if volatility is the standard deviation of the expected move, which it is, over time, we would expect the market to move more between now and 3 months than between now and in a week. Now, of course, that's also corrected for distance and time, but generally, volatility is higher. The expected move is greater out in time. Okay, so we have that going on. So basically, we're kind of, I'm going to pull up, where is it? Chrome. Here we go. Gonna poke around here. First, I'm going to do it a more simplistic way. This is bar charts. There's a lot of different places that you can access this. Just an easy peasy way to look at open interest. So this is open interest for VIX. Um, the expiration coming up. Huge open interest at 25. Using open interest at 20. We're stuck here. We ain't going below 20. Might not go below 25. Here's where it's 30 right now. 200,000 contracts. This is important. This had to be hedged as we were heading up. And this, if we stay away from that, then that delta gradually recedes, and whatever hedging was done, buying slash VX futures or whatever other product they buy to hedge that volatility comes down, and that maybe can get us back below 25, can maybe get us between this area. Conversely, and we have 24. You see, we have, if I order it by strike, you can see where the large 24 is a large level, 23. So there's large levels all along the chain, with 20 being what we want to, ideally, if you're a bull, you'd love to see below 20. On the put side, there's not much. When we were up, I was seeing when we were low, and I was one of these people selling. I was selling 17 and 18, actually slightly in the money puts when it looked like vol was too cheap. Vol was 16 maybe at the time, and so I think a lot of these puts are sold. Certainly the lower ones. I saw a lot of back then 18 combos coming in. My guess was people were selling 18 puts and buying 18 calls. I don't know. Um, Here you have puts at 20. I'm going to guess these were buyers. And so that just adds weight to the 20 inflection point. So those are your VIX inflection points to just kind of keep in the back of your mind. Now let me go to the dashboard. And let's take a look at VIX, see what we can pull up here. Okay, we have numbers coming up in 1 minute. And momentum is very high, as we know. Let's take a look at, let me see what we got here. Okay, so here's a different view of the same thing, open interest. This is throughout the chain, but it's going to be analogous. And you see the big open interest at 20. As long as those are in the money and they are not a one delta, market makers are going to be buying to neutralize this. So now 25 is the big number. Let me see if this bar chart thing gives me the delta of the 25s. It's not telling me the delta of the 25s. Someone can check their chain. I'm guessing the delta of the 25s is going to be a 7. Now, deltas on VIX act a little funny sometimes, so I can't really comment on that, on what this delta should be. But this is going to have to be hedged, buying toward this if we're above it and selling if we're below it. I guess numbers came in. And yeah, okay. I don't see much of a reaction to the jolts. Is there anything else we want to see? Oh, here we go. There we go. Yeah, that's right. We talked about this. So here's a nice, easy way to see the distribution. Much easier. So here you see the 20 is the inflection point. This is a big solid wall. And you got some puts there, so it inflects. These deltas decrease, these increase. Should we head down there? But you see we have a lot of calls in between, and it's gonna be rough to get through this. We gotta get below 25 to have a chance. 30 is magnetic, but also charm flow pushes it down. Should we not get there? And so that's kind of those are kind of like your big what did I do here? Okay, those are kind of your big levels to think about. I don't know what the numbers were, but I don't see a big disaster. So I'm going to take that as a positive. Let's look at SPX. And I think I'm not going to belabor the point, but we're put dominated. Just look at this. Red is no bueno. We have some positive deltas all the way in June, but it's a bit of a way off. Let's take a peek at. Oh, I don't see the little open interest thing that you have over there. So let's just take a look over here at the open interest. And you see we're buried in puts. There's not many calls in here. We have some calls here at, what is it, 5,700, which makes what part of what makes it a powerful inflection point. And so over 5,700, then we can inflect a little bit, but these puts, these deltas need to erode. We have to get over it. Volatility has to go down. That'll make those deltas erode somewhat, but they're in the money. So the most sensitive to changes of volatility are roughly the 20, 25 delta, even 16 delta, even 30 delta. And so kind of in the money like that. Well, actually, once you get up to 80 delta, then they're sensitive again. But 50 delta are probably the least sensitive to changes in volatility. And so, yeah, there's that.
Maybe Doc, one interesting thing, like maybe I can show it, is if we
And
look at the skew. So if we look at our skew, this is
oh,
the
good.
first expiration skew. So it's today's expiration. So it's the zero DT is kind of like skews, and as you can see, kind of like now we are kind of in a call bias, meaning that the implied volatility of calls for zero DT's options for today is actually higher than puts. So kind of interesting to see.
Right. So, um, as most of you know, but I'll just remind you, skew is basically the difference between the price of calls versus puts. Puts tend to be more expensive than puts. So there's tends to be a difference. However, so when you look at skew, it's relative. It's relative to historical,
Yeah.
etc., or relative to where it is recently. And you see that there seems to be some kind of call demand, which makes sense. Not necessarily that there's a strong demand, but puts are expensive. If you tried to buy puts yesterday, they're expensive. If you bought puts for today, yesterday, or for Friday, you paid a crap load, technical term. And for those puts to realize and be profitable, we need either another volatility spike, hard from here, and a big move down. And a big move down. So it makes sense that the call demand, that there's going to be a bias toward calls. It just sort of makes intuitive sense.
Yeah.
Let's look at key levels. And so, and again, just kind of quick thing, back to my dashboard. Okay. So if we just look over here, quick down and dirty. Um, we see 1D max, 56.93. So we'll call it 5,700 ish. We see the min 55.35, call it 55.25 ish. Um, so I would start above and below those levels or near those levels and move further out for selling iron condors. Now, again, this is not a faint of heart day to sell iron condors. Now, notice it says put support 56.75. That's just because of the way the, it was the naming was when they originally did this. I'm going to keep bugging them to change it to call it something else. They're not gonna, but they got too much other stuff on the development queue. But that's a significant put open interest level, which I mentioned before as a potential magnet or stopping point on the way up. So it's a significant level of volatility reaction zone, not necessarily support. Of course, since we're below it, it's clearly not support. Um, IV rank is 100, so IV is kind of nuts, you know. Um, and so everything is telling us we're at an extreme.
Yep.
I see he didn't take the bait when I mentioned changing the naming. Okay.
Yep.
And CTA models, I'll just do a quick look at that. And again, if you follow any of the flow people, there's lots of different models out there. They all say the same thing. When we look at SPX, that positioning, that trend following hedge funds, their positioning is near a low. They're selling, but according to models I've seen, they're going to have to keep selling until there's some kind of trend reversal. Especially, they need an uptape for a while to see some buying come in. Do we have vol control funds here?
Yeah, under all models.
Yeah,
Yep.
vol models. No
Uh,
default command. What
click
do I
on
load?
yeah, click
Oh,
on load default commands. Yeah. Uh,
volatility control fund. Okay. And so these are funds that broadly speaking tailor their allocation to stocks or to whatever kind it is to the volatility. So when volatility is high, they sell. When volatility is low, they increase exposure. They're down around 6%. I think they're down a little bit more than the market this year. So actually, I think it's a dumb strategy. But what do I know? They tend to not perform very well. They perform well when we're trending. When we're trending up, because they add allocation as we go up, they add more and more. So from here, when they start adding, they tend to do well, but then they start selling as we go down. So they tend to buy near the highs or as we go up, sell near the lows and keep selling as we go lower. But long story short, with them, they're at a point where it's going to be a while until they start buying again. And so the short version of that story is it's going to take a while until we get help from CTAs and from hedge funds and all that kind of stuff. We're probably looking at more selling, less allocation there.
yep.
Okay, I've overstayed my welcome. It's 8:39. In theory, like to just try to get off by 8:30. Any comments, questions, whatever?
Yeah, let's see if we get questions. Thanks, Doc, as always.
Thank you. Always fun doing this. Hope this was helpful to you guys.
Yeah, here I just want to remind you guys that this week we're also going to have a pack session. So we have a session today with Scott Pulcini on Bookmap. So if you want to learn how to leverage MentorQ data and Bookmap, great session today. We're going to have a live trading session tomorrow with Anne-Marie from Top Step TV. We're going to be back with Doc on Thursday. We have a session with Joel, and then we're also going to have a session with Jason from PyQuant News on Python and quantitative strategies. And of course, we're going to be back with our normal schedule next week. So for those who want to join, please sign up to our YouTube channel and go under our live session. And you can also look at all the ones that we did for last week. Thank you very much, Doc. And see you guys again later today and tomorrow.
Okay, see ya. Thank you.